The Fed has been tapped for $150 billion in the month of December alone through the standing repo and the temporary open market operations facilities. These liquidity draws are garnering a sense of worry within the banking system because of the recent commodities, gold and silver runs and blow-off tops that we've had leading into the Christmas holiday season. A lot of the chatter on Twitter is regarding a big GSIB bank being hit for collateral or margin requirements on their silver or gold shorts, forcing them to tap the Fed for immediate liquidity needs and constraints. We are going to discuss the three major tools and mechanisms that the Fed uses in order to inject liquidity and remove it from the institutional system. This will be the standing repo facility, the TOMOs, and the reverse repurchase markets, or simply stated, a reverse repo. Now, if you want to keep track of all these liquid injections and the economic data surrounding it, you can look at the Federal Reserve Economic Data website, also known as FRED. This database is kept by the Federal Reserve Bank of St. Louis, and it tracks GDP, unemployment data, inflation, interest rates, total money supply, basically every data point that you would need to know what is going on between our tier 1, tier 2, and regional banks and our central banking system at any given moment in time. First up is the standing repo facility. Now, what this is used for is emergency liquidity requests from the Fed by institutions like GSIB, primary dealers, and tier 1 banks. Tier 2 banks and Tier 3 regional banks can also request money through the SRF, but not directly from the Fed. They have to go through primary dealers and the Tier 1 banks in order to do this. Now, this is temporary, overnight emergency liquidity, and that's it. Institutions needing immediate cash will post collateral like treasuries, mortgage-backed securities, and agency debt, and this is not announced ahead of time whatsoever. This is why when you look at the FRED chart, you see these immediate spikes in December. 26 billion. 16 billion, 25 billion, 74 billion. This is the SRF being used and requested because somebody has margin or collateral constraint requirements and they're in need of immediate cash. This could be the result of the commodity blow-off top in silver, where institutions were majorly short commodities during the COVID collapse because trade routes were shut down and commodities were not in high demand as equities at that time. Next up is your temporary open market operations facility. In this chart, you are going to see more passive flow as the Fed's New York trading desk identifies liquidity stress and risk in the banking system and holds an auction. Now, unlike the SRF, which was emergency liquidity, these auctions are announced ahead of time. Additionally, unlike the previous chart, which was treasuries plus mortgage-backed securities plus agency debt, this TOMO chart is only looking at treasuries. So when institutions like pension funds, asset managers, hedge funds, and insurance firms need liquidity, they go to these auctions, they exchange their collateral in treasuries only for liquidity from the Fed. That's why when we look at this chart, you're going to see the numbers are a lot lower than the previous total chart, which was 170 billion in December. This chart will be much lower at around 72 billion in liquidity requests from the Fed in exchange for treasuries for the fiscal month of December. And finally, remember, this liquidity request is also like the SRF, temporary and overnight. The only difference with the TOMOs is that you can extend out to a week or 10 days, depending on if you have a specific contract as counterparty A with the Fed on a time period that fits both of your business needs. Okay, last but not least, the reverse repurchase agreements markets. Now, as we've spoken about many times in the past, what a repurchase agreement is, or a repo, is when an institution like a pension fund, hedge fund, asset manager, or insurance firm wants to post some type of collateral like treasuries, mortgage-backed securities, and agency debt in order to receive liquidity temporarily from the Fed. That is a normal repo. In a reverse repo, it's the exact opposite. Instead of the institution posting collateral, they want to receive that collateral from the Fed, and they want to basically park cash in the RRP markets or facility. Think of the reverse repo markets as a place where excess cash and liquidity can be stored for a fixed income overnight rate, also known as the repo rate. And this is calculated at the end of every single business day. Now, the only way you get money into the RRP is via a money market mutual fund. And as you guys know and have heard in the past so many times on Twitter, there's something like $7.5 trillion sitting on the sidelines in money market mutual funds because investors right now don't have a ton of confidence in the markets to be fully risk on. All right. We have a lot of fiscal and monetary debt issues. Inflation is out of control. Corporate earnings are not so stellar across the board. The Mag 7 is basically doing the brunt of the carrying. So the reason why you see this chart peak at that 2.5 trillion in December of 2022 is because Powell was coming off of his fastest rate hiking campaign in stock market history of 11 hikes in 1.4 years. And that made government debt and government T-bills have a higher yield around 6%. So firms started diversifying instead of sticking their money in that safety net of the RRP with the repo rate, which was around 5.25. Now they're getting in government debt, which is at 6%. You see the RRP start to drain as they start buying government T-bills in the short term. At the same time, handling debt obligations and collateral management, getting that RRP fund all the way down to that 8 billion mark where it's virtually at zero. The reverse repo markets and facility is incredibly important to keep flush with liquidity because it allows firms a lot more leeway. They have tighter spreads, they can have more leverage. It creates a much more looser lending environment where stocks can go on an absolute roar. Eventually, the Fed is going to have to print money in reserves, credit that, which will turn into deposits, which will somehow find its way into the RRP. So the stock market can go on a second COVID run to new all-time highs in the distant future. So that's it for our educational lesson this week. Guys, if you have any questions, hit me in the comment section. Again, if you want to join the Yield Boss Discord, you know where to find me on Twitter. Keep studying, keep at it. The only way that you're going to be able to better your family and be successful at trading is if you put in screen time and keep watching these videos, keep learning. It takes a while, years, but trust me, it will pay off in the end, and you will better be able to navigate the current high debt and inflation environment that our economy is in and better your family over the next decades to come. Love you. Talk to you later. See you next time.